Hello again. So today we're going to start off by talking about the cash basis of accounting versus the accrual basis of accounting. So the reason this is important is because one of them is acceptable, one of them we do, and the other one not so much. All right, so the first one we're going to talk about is the cash basis of accounting, which pretty much says, okay, anytime we receive cash or we spend cash, that is when we're going to make a journal entry. That's when we're going to go into our accounting records and record something. However, if we've completed some work, if somebody owes us money, we don't record any of that under the cash basis. The only time we record anything is when cash exchanges hands. All right, so now we move into what we call the accrual basis of accounting. The accrual basis of accounting says we will record our revenues, our money coming in, once we have done the work, which means if I am a painter and I go and I paint somebody's house, as soon as I've completed the job of painting that person's house, they owe me the money, and therefore, under the accrual basis of accounting, I am going to record that as revenue. However, on the other side, if someone gives us cash in advance, we haven't done anything to earn the money or anything like that. They just come and give us cash. They're like, hey, here's a $100 deposit for some work you're going to do later. Well, under the accrual basis, because we have not done any work, then we will not record that as revenue. That will go into an account that we'll talk about later called unearned revenue, which is actually a liability. All right, so keeping on with the accrual basis of accounting, under the accrual basis of accounting, we have a couple of categories of revenue recognition. Revenue recognition is the principle that basically revenue is recognized once it has been earned. So regardless of when we actually receive the cash, we don't care. All we care about is, have we done the work to earn the money? All right, and then also underneath the accrual basis, we have what's called the matching principle. The matching principle relates to expenses. It pretty much says, okay, if we've done some work, we've earned some money in a certain month, we want to make sure that our expenses match to that month. So if I'm the painter and I've painted someone's house, then the correlating expenses for that job, I want to make sure and recognize them all in the same month. An example I often use in one of my classes is if I'm thinking about my own personal bills. Whenever I get my paycheck for that month, I go ahead and pay my mortgage or my rent. I go ahead and pay that because, well, first of all, it's due. I owe it. It's something that is owed. So I go ahead and pay that. Another reason why I go ahead and pay it is from a matching perspective. I need to match up my expenses to my paycheck. You know, I could decide to take a really good month and just go and spend crazy, but then the following month I'd owe for 2 months worth of mortgage or month of rent, 2 months of rent. And a lot of people, normal people, cannot sustain things like that. So that's why we also do the matching principle. And that's pretty much it. So under cash versus the accrual, cash is not acceptable under GAAP, the generally accepted accounting principles. However, the accrual principle is what we go with. From an accounting standpoint, we're always going to think about accrual. Remember, cash follows cash. So we're only recording things when we have received money or spent money. The accrual basis says, well, we don't care about cash. We don't care anything about cash. Have we earned the money, or do we owe the money from an expense standpoint? All right, see you next time.